So a big focus right now on equity markets because we've seen them rise quite extensively. As I mentioned, the Dow Jones very close to that key 10,000 level. But at the end of the day, it's all about asset allocation and where you'd be getting the best returns. Would you say the best returns right now lie in equities?
Yeah, probably. I mean, if you look at the dividend yield now on stocks, it's about 2.64%. But if you take into consideration, I mean, 2.64% doesn't look that attractive relative to, to other asset classes here in the South African space. But if you take into consideration that dividend yields or dividend payouts or dividend change in dividend year on year is actually down 30% or 27.5% going into 2009, at some point dividend payouts will have to start increasing again. And then you can quite easily, on a forward basis, say that your dividend yield is not 2.64%, it's actually far higher than the 2.64%. And I mean, that's interesting because, a lot of people are looking at the equity market at the moment and saying, well, this thing's fully priced. Where can this thing go from this point forward? But if earnings next year continue to surprise on the upside, or there continue to be good numbers coming through from corporates, then that's going to be very good news for the equity markets. And let's face it, we're in a bull market. So, if markets pull back 5, 6, 7%, and then they start going up again, 5, 6, 7% pullback in the equity markets is a fantastic opportunity to then acquire more equities.
Cobie, how do you gauge which asset class is attractively priced right now?
Well, that's an interesting question because you see, everything starts from the cost of capital. So you have to understand, and before you understand the cost of capital, you have to understand inflation. So once you understand inflation, you understand the inflation picture, you can understand what happens to cost of capital. And that really is, I mean, there's a whole bunch of ways you can slice and dice cost of capital. Let's just, for simplistic arguments, call it the bank rate, what you can earn in the bank. Once you can understand that, you can understand what bond yields will do, and you can understand what equity yields will do, etc., etc., etc. And then property yields obviously fall into that equation as well. And it's really about an inflation outlook and understanding what is going to happen to inflation and how it will impact all the various asset classes. Generally speaking, low inflation rate environments and inflation rate environments which slowly climb over time is pretty good for equities and for property, but for that matter. Very high inflation environments aren't that great, for the equity environment.
Well, so Cobie, let's take a look at the South African environment then. I mean, at this stage of the game, we're still very far away from that target band, and the inflation outlook, relatively a mixed picture depending on who you speak to. Some said the electricity tariffs are going to impact inflation quite negatively, of course, wage negotiations as well. Taking a look at South Africa's inflation outlook, how would you be investing?
I mean, if you take the target band of 3 to 6%, into consideration, we're sitting at 6.4, down from the 6.7% level. Yes, as far as electricity and what we call services, the services element, that obviously is going to chase inflation up, but to what degree will it chase inflation up? If you sit at 7%, yes, you're slightly outside the target band, but it certainly isn't very, very aggressive inflation. Aggressive inflation in the South African environment is 11, 12, 13, 14%. 7% is not really that aggressive. Even 7.5% is not really that aggressive. Maybe the repo rate then goes up by 50 points, maybe 100 points, which means, I mean, if we look at the repo rate at the moment, repo rate's sitting at very, very low levels. As a matter of fact, in the boom of 06 and 07, we never sat with the repo rates, this low. So, even if we put it up 100 points, it's still pretty good environment for equities.
In terms of real negative interest rates, because that's what we're sitting with right now in South Africa?
Well, are we sitting with real negative interest rates? I mean, rates are running, CPI is running at 6.4 and repo is running at 7, and you've got your prime running at 10.5 or 10. So it's not real negative rates at the moment. That's not necessarily the case internationally. Internationally, that could very much be the case. But I mean, understand that the international situation is on the back end of a financial crisis that they've had. So they're trying to pump money and liquidity into that system, and I mean, take your cue for the South African market from what's happening internationally as well, because you're sitting with structural weakness in the dollar, and they're trying to keep it weak as long as they possibly can, because they're trying to create jobs and they're trying to create stability in their economy, and that's obviously good news again for South Africa.
Let's compare equity market growth and dividend growth over the last few years. I mean, how do they compare?
Well, firstly, I mean, if you look at equity market growth and you look at dividend growth, the two don't align precisely. It's because the equity market continuously try and chase what's going to happen in markets, and it's forward-looking, and if it's wrong, it then pulls back. And in the same light, if there's a sentiment change and there's mass panic in the market overreacts on the bottom side and then realizes it's overreacted and then comes back. So a better gauge So you've got this one element that has got huge amounts of volatility attached to it, but you've got dividend growth on the other hand, which is actually quite stable. Now, since 2005, dividend growth rates in South Africa has been in excess of about 20% per annum. Okay. Before that, the growth rates were slightly less aggressive in South Africa, and that's just all part of an emerging market boom that we've had. The interesting thing is that if you go back to data from 1996, the last time around we've had dividend growth rates actually in negative territory was in 1998, which is an emerging market crisis. And there it was only down about 0.4%, whereas now we're sitting with dividend growth rates which is down minus 30%, minus 27.5%, which is certainly a huge number, if you take into consideration data in the past. And at some point, dividends will have to catch up. So you can't take a dividend yield number today and say, oh, this is reality, because at some point people will stop paying dividends again. Anglo-American, who suspended their dividend, will stop paying a dividend again, and that'll obviously filter back into the system. The interesting thing, though, is take the long-term average rate, or long-term average growth rate for dividends into consideration, and you get to about 14%. This is now since 1996. Take the dividend payouts out of the equation for your all-share index, okay, and the growth rates, and that's also 14%. And that shows you that long-term, maybe markets are efficient.